Hey guys, so welcome to the second installment of this series, and we will be talking about trading strategies. So in the previous video, we've already talked about how to set up an account, and we've done a quick rundown of the basics of the trading platform. So in this section, you're going to be asking yourself, so how do I know how or when the market is going to go up or down, and how do I have a systematic way of knowing when to place a trade, either a buy or a sell, repeatedly. Yeah, so we're going to cover introduction to trading strategies, and it's going to give us a guide onto the mindset of a trader. What process do I need to follow when placing either a buy or a sell on the markets? So when you talk about trading strategies, you can break them down into two, and that is the signal generation part and the risk management part. So when it comes to the signal generation part, it's simply what conditions or what is the criteria that you're going to use to decide when to buy and when to sell. And when you talk about the risk management part, this is how much you need to risk or what is the plan around you mitigating some of those losses in the market. So those are very two specific areas that you need to spend time on. But on this video, we are going to focus on the signal generation part, and we can break this down further. So indicators, so we can break this down further into the specific conditions, a confirmation mechanism, and the time frequency in which you're going to trade, or the time or frequency in which you're going to trade. So when it comes to indicators or criteria, or having a criteria, this is basically what do you need to look at before placing either a buy or a sell in the market. Yeah, and this can be of different tenants or of different principles. The two main ways to look at the charts is through technical indicators or fundamental analysis. So technical indicators is when you're using patterns on the charts. For example, if I wanted to know what the weather is tomorrow, I can look at the weather patterns for the past 2-3 days. That can give me a prediction to some extent of what is going to happen tomorrow. Then other way to look at or predicting price movement is through fundamental analysis. So you can look at things like global macro news, geopolitical risks, and things like that, and that's going to drive prices on the chart. So if you're a good analyst or a good research analyst, you can always get into either one of the two, either fundamental analysis or technical analysis. In this session, however, we're going to be looking at technical indicators, and this is going to help us deduce patterns from the chart. Now, what are indicators? Indicators are simply add-ons that you have on the chart that help you identify patterns. Yeah. Again, we're looking for patterns just to know where price is likely going to move. Yeah. Once you have a set of conditions or indicators that we have clearly identified, then we need to know how to arrange them and what to look at first and what to look at last. And this is simply our confirmation mechanism. Yeah. So you have your set of indicators, confirmation mechanism, and then lastly, you need to decide under what time frame you need to be looking at this indicator. So if you have a lot of time on your hands, you can simply decide to use lower time frame. So anything from 1 hour all the way down to 1 minute, 5 minutes, those ones you can use. If you have time on your hands, they basically give you more signals, but there's also more risk involved and it requires more time. Anything above the 1 hour time frame, you basically need less time to look at the charts, because usually it takes a longer time for prices or patterns to form on the 1 hour going up time frames. But then again, that gives you leeway to do other things with your time. For example, if you're in classes, or if you have a job, or if you have a business and things like that. So you need to have a very clear distinction of what type of trader you are, and also your personality. So there are guys who are very patient and you can wait for trades to play out on the larger time frame, and there are guys who want things or to see results instantly, and that is usually ideal or recommended that you use lower time frames. Okay, so getting on to the signal or indicators criteria, you need to know, for example, specific indicators that you can rely on over time. So in this video, we're going to look at two indicators. That's the Bollinger Bands and the RSI. So quickly dive into that. First, we'll start with Bollinger Bands. Again, I have my mobile device and PC, so I'll just quickly run through how to install indicators on both devices. So on the PC, I'll just open my MT5 as such, and on the mobile device, my MT5 is already open. I can decide to go and do my analysis right now. So if you're using a PC, just simply go to the insert icon and then indicators, and then you'll find all your indicators over there, from the trend indicators, oscillators, volumes, Bill Williams, and custom. So these are the 5 categories of indicators. If you're using your mobile device, you just click on the F button at the top, and this will take you to the indicators page. And for me, you just click on the add sign, and then you can still see there's a trend, oscillators, volumes, and Bill Williams. So those are the main categories of indicators we have. And for Bollinger Bands, these fall under the trend indicators. So I'll just apply this like this on the PC, and it's the second on the mobile device like that. Click on done on the top right, and we have our indicators plugged in onto the chart like that. So these are Bollinger Bands, and let's quickly learn about what Bollinger Bands are. But if you're inserting any other indicator from your phone, just go back to the F button and then just click on the main window and add other indicators from there. Same thing applies if you're using a different device. You can just click on the F plus button or the wavy line if you're using maybe an Android device, the wavy line at the top of your chart, and then just go back to the F plus button, and that's where you can add your indicator. So it's very straightforward. I believe we all have a clearer picture. So we'll add another indicator for if you're using your mobile device, and that is the relative strength index, which we'll talk about later in this video, because we'll be combining 2 conditions for us to look at the pattern. So if I add the relative strength index from the mobile device, that's how it looks like. And basically any other indicator, the process is the same. So I'll switch on to the PC version so that we can get on with the analysis from there. Okay, so getting back to the notes, or getting back to the slides, you can see a brief definition of what the Bollinger Bands is. So you can notice that, or you've noticed that when you added the bands, there's the middle band, the upper band, and the lower band on the charts, and this dictates how price, or this is an inference of how price is moving. The middle band is basically your moving average. Now, why would I be interested in having a moving average on price? Things always tend to the average, even in real life. So if I look at this chart, for example, I can see that over time, we have prices coming back to this middle band whenever they deviate too far away from the band. So this is a good example over here. We had prices moving up like that and eventually came back down to the middle band. So it's a very good way to start noticing patterns in the market. That is, if prices are too far away from the average, eventually they come back to the average. And it's the same thing in real life, where we have, for example, temperature. If the average temperature of a place, for example, Nairobi, is 20 degrees, anytime you see prices or temperature going too extreme, 30 degrees, you know that eventually it will turn back down to the average. And that's the same thing over here. So if I see, for example, prices moving too low over here, that's an example, then you know that eventually, or after some time, prices will turn back to the average, which is the middle band. So that gives us a good amount of information to know the likelihood of prices turning back to the average. So let's quickly go back to these notes, and from here you can see that you can use the Bollinger Bands to tell you a number of things, and this is basically based off of the upper band and the lower band. This gives you extreme prices for the market. Yeah. So the upper band is simply a two standard deviations away from the middle band, and the lower band is 2 standard deviations away from the middle band. So these give you some sort of extremes to work with when you're looking at prices. So you can say the upper band as the upper limit. You can identify the upper band as the upper limit of prices and the lower band as the lower limit of prices. So that tells you if prices move too much to the extreme, to the lower limit, for example, there is a high likelihood of prices coming back to the middle. So that's one way to observe patterns, and you can use the Bollinger Bands to deduce basically 2 types of patterns or information from the charts. And the first one is volatility. Volatility is simply how much price changes from the mean, and this gives you a good estimate of when to get into the markets and when to not be in the market. So there are guys who depend on volatility to make money. So if prices are not moving as aggressively, then it's very hard for you to realize any gains or any losses. So it's going to take a longer time in the markets for you to actually to get any form of results. So it's very important for you to, especially for day traders, to get into the market when it's very volatile. So that's one thing you really need to look into. So you can look, for example, on this chart. At this point here, we had a very huge gap between the upper band and the lower band. And this can tell you that the market was very volatile at this point. And then we have this other instance over here where the upper band and the lower band was somewhat very close together. So this can tell you that there is somewhat low volatility on the market. So that's one way to look at the charts. So the other way to look at Bollinger Bands is through the lens of whether the price is too far bought or too far sold. Basically, is the price overbought or oversold? So these terminologies are not very complicated. Overbought simply means that buyers have gotten into the market to a point where the prices are too high. Remember, when there are more buyers, prices tend to go up. If there are more sellers, prices tend to go down. So when there is a lot of demand and people are buying, eventually the prices become too expensive and buyers start losing interest, and some even start booking profits. So that's condition in the market is called an overbought condition, and the vice versa is also true. When there are so many sellers in the market and the prices, or when there's a lot of supply and prices go down, eventually what you see is people start having interest in that asset. Why? Because it's too cheap. Yeah, that's when you start seeing buyers coming in. So when the market is overbought, there's a high likelihood of prices turning, and when the market is oversold, there's also a high likelihood of prices turning and start going up. Yeah, so you can use the Bollinger Bands as a proxy for overbought or oversold conditions. So here it says prices near the upper band may indicate overbought conditions, while prices near the lower band may indicate oversold conditions. Now these are good conditions when you're looking for price reversals. If the market is overbought, then there's a high likelihood of prices turning. And if the market is oversold, there's a high likelihood of prices turning and going to the upside. So that's one of the conditions to look at. And we can basically observe this here. So I'll give a few options. Okay, you can see, for example, over here, there are a few instances where prices went to the upper band and then we experienced that reversal like that, and like that. Yeah. And there are a few times when prices went to the lower band and we had that reversal over there. Yeah. So you can notice that it's not in all cases where prices reversed from either the upper band or the lower band, and that's very important. When it comes to trading, especially when you're identifying patterns, it is not given that all of the times your patterns will be 100% accurate and your predictions are going to be accurate all the times. So you need a way to sort of filter out higher probability setups from lower probability setups. So when it comes to trading, you're still thinking in terms of probability, and that's very important, especially when it comes to risk management. Yeah, so in this case, you can see on these areas over here, we had prices reversing anytime they hit the upper band, and we had this instance over here where prices kept on going lower up to this point, and this is where you had a reversal finally. So prices kept on going lower even though they hit the lower band. Now that is important as we are going to talk about how to filter out trades. Remember, when you are starting the session, we said you need multiple conditions or more than just one criteria for you to understand how to trade. So in this case, yeah, we have seen that we can use Bollinger Bands to identify potential reversals on the chart. How? When prices either go to the upper band or the lower band. However, there is more to that. It's not all the times that when prices go to either the upper band or the lower band that prices are going to reverse. So you need to be very careful with that, and that's where the caveat comes in. Bollinger Bands are not foolproof. False signals might occur, especially in ranging markets. So in as much as we have this condition that we have built up, which is prices tend to reverse on either end, we still need a way to filter out or we still need a way to make sense of higher probable strategies and lower probability strategies. So that brings us to the next condition, and why we talked about having multiple conditions and not just one condition when it comes to trading. The next condition is a different indicator, in which case it's the relative strength index. So how will I look at the relative strength index? This is simply a momentum indicator, and it measures the speed of change with price movement. So I'm going to quickly go back to the charts. Remember, we've already talked about how to add indicators on the chart. So I'm going to just go to oscillators. So the relative strength index is under oscillators, and then click on the RSI like that, and then say okay. So there it goes. So another thing is, most of these indicators have default settings. It's good to leave those settings as is. Yeah. So I'll just clear out my Bollinger Bands from the chart so that we can talk about the relative strength index. Let's have a look at this over here. Okay, so again, we've said it's a momentum indicator. Why is it a momentum indicator? It measures the speed of change. So if you see, for example, the RSI rising sharply, it also implies that on the chart, prices relative to maybe a previous period were also rising very sharply. So in this case, this is a good example. Let me just delete this. This is a good example of a sharp increase in prices based off of the RSI. So it's a good reading. Anytime we have, for example, the RSI falling gradually, like that, then you also see that price is falling gradually. So there is that correlation between what is happening over here and what is happening over here. Yeah. Now, what else can we notice? If we look at this RSI, you can see that movement is bound between the 0 and the 100% level. Yeah. So in this case, if you look at price, it can really move to any level, but the RSI only moves from 0 to 100. So that's a very important thing to note. You can tell how high is too high when you're looking at the RSI, but you can't tell how high is too high when you're just looking at naked price action. And in this case, for example, this push over here, for what you could know, it could continue going higher, but the RSI gives us some sort of relative movement. And that is why you can see that anytime the RSI goes above this 70 level, yeah, it tends to come back lower. So you can see that, for example, here, RSI tends to range between the 0, the 30, the 70, and the 100% level. And more specifically, these two levels, the 30 and the 70 level, are very important. Why? Because that's where most of the movement tends to be confined in. So if I zoom this out like this, if I zoom this out, I can see that in most instances, when we have the RSI breaching the 70% level, then on the chart, we have sort of the same thing, where if the price breaches the 70% level, there's a high probability of us having a reversal back into or below the 70%. And in this case, you can see that eventually, after staying for some time, we did come back lower. Yeah. And the same thing can be said for the 30% level. If price breaches the 30% level, so I'll just mark that over there, you can see that also on the RSI, while the RSI was turning away from that 30% level, prices also managed to turn away from that level. So it gives you a good relative description of where price is at. Yeah. So having said that, we can say that here, prices were not below the 30% level. So there was a high likelihood of us continuing to go lower. Yeah. So there's always that at the back of your mind when you're trying to look at, is this potentially a turning point on the charts or not? And the RSI is a very good guide for that. Yeah. So getting back to what we've talked about the RSI, we can summarize it as follows. Number one, it typically ranges from 0 to 100, and the same story about overbought and oversold conditions come in. In this case, we have the overbought conditions when the RSI moves above 70 and the oversold conditions when the RSI moves below 30 level, the 30 level, yeah? And this then guides us on what prices are doing. So number one, you can identify a potential reversal if the RSI is above 30 and a potential reversal also if the RSI is below 30, yeah? Okay, that's the first way to look at the RSI. Remember, for most of these indicators, you can use them for multiple things. They're still add-ons on the chart that give you patterns, and these patterns can vary dramatically depending on what you're using these indicators for. And the second important thing, and what we'll be using it for in this case, is to identify trends on the chart. Yeah, we're going to use the RSI to identify trends on the chart, and that's what we'll be talking about here. So we do know how to edit the RSI from both, or to add the RSI on both the PC and the computer, but we might need to make a few adjustments for us to have it viable for this second piece, which is how do I identify a trend based off of the RSI, yeah? But then again, why do we need to identify a trend? Whenever you're trying to make predictions of things, usually a good idea to start from is knowing what the overall movement of that thing is. For example, if you're trying to start a business in fashion, you need to know, for example, what is trending, and from that you can stock up on your store what exactly a lot of people are buying or selling. So that's the same thing when it comes to charts. You need to know the overall direction of price, and then from that you have a more specific idea of what to do next, and that's where the RSI comes in. So we need to edit both our indicators, and to do that from the PC, you just simply go back to your hover on your RSI and just right click on it and just say properties. If you're using your device, it's not very complicated. Just go to the F button again and click on the RSI that you've added, and now we're going to add a level. So I'll click on level like that and add 50 on the mobile device, and a level, they just click on it and then add level and then add a 50 level like that. So it's very straightforward. Click on OK, and that's what we have. So click on done. So now we have an additional level on the charts, and that's the 30, 50 and 70 levels on the chart, yeah? So that's how we add levels on the RSI on a mobile device. So I'll just quickly switch back to the PC version. Okay, so again, we know why identifying a trend is important. Let's just see how to do so on the charts. So the basic procedure is, if the RSI tends to stay in the 50 to 90 range, then that's a strong uptrend. And if the RSI is below the 50 range, that is between 10 and 50, then we are in a strong downtrend, yeah? So it's very straightforward. Let's look at instances of that on the charts. Okay, so for example here, we can see that this area over here can be defined as an uptrend. Why? Because we had this huge push over here up to this point. Actually, it's here. So let me just, yeah, so you can see this area coincides with this area, and immediately the RSI fell below the 50 level, then we can start defining our chart as having been in a downtrend. Very straightforward, yeah? Another good example of RSI is over here, where we had RSI being above the 50 level, and if you look at the charts over here, sort of the same thing. We have that where the RSI coincides with an uptrend in the chart. So it's easier when you have a lot of experience on the chart to identify a trend, but when you're starting out, it's very straightforward to just look at, are we below 50 or above 50? At the moment, we are still below the 50 level. The RSI line is still below the 50 level, so we are technically still in a downtrend. Yeah. So those are the two ways you can use to identify patterns on the chart using the RSI. The first one is to identify overbought or oversold conditions, and the second one is to identify what trend you're in on the charts. So we're not going to be identifying overbought and oversold conditions twice. The Bollinger Bands are already doing that for us. We said we need to have criteria to look at or conditions to look at, and because we have two indicators, they need to be telling us diverse things for us to make our analysis. So we are going to build our first trading strategy or first trading criteria using those two, and we're going to use the RSI to tell us one thing and the Bollinger Bands to tell us another thing. So when you're talking about a strategy, again, remember it's a set of conditions. Yeah. Okay. So in this simple RSI Bollinger Band strategy, all we will be looking at is, number one, what's the overall direction of the market? Once you find the overall direction of the market, we will be looking to trade in that direction. So if we are in an uptrend, we are looking for buy signals. If we are in a downtrend, we are looking for sell signals. It's very straightforward. And we can use the RSI, we just discussed that, to identify trends in the market. So if the RSI is in a 50 to 90 range from the charts, then that defines an uptrend for us. So we'll only look for buys on the charts. If the RSI is below the 50 range, we are in a downtrend. So we'll clearly just look for sells. It's very straightforward. And then from there, now, because we've discussed about our Bollinger Bands, that's where they come in. So we'll use the RSI on a higher time frame and then the Bollinger Bands on our lower time frame to pick out specific trades. Yeah. So if the RSI on the higher time frame has identified to us that, for example, we're in an uptrend, then the Bollinger Bands are going to dictate when to buy on the lower time frame. So let's just quickly have a look at that. Okay, so going to go back to this chart. This is USD South African Rand. You can see that clearly from the higher time frame, we are below the 50 level. Yeah. So if I check this section out over here, it does coincide with this section around here. So we clearly are in a downtrend. Yeah. And if you're looking to day trade or you're looking to trade between the day, then at this point you're only looking for selling opportunities. Yeah. So if I go to a lower time frame, for example, now 15 minutes, remember the higher time frame is what you use to identify the overall direction, and then the lower time frame is what now you can use for entries. Now on the 15 minutes, I wouldn't be looking at the RSI. I'll only be looking at Bollinger Bands. So I can just go to here and then select on Bollinger Bands like that, and then okay. So that's plugged in like that. Now remember what we talked about Bollinger Bands. You can always rewind this video. We said if the Bollinger Bands are on the upper band, then there's a high likelihood of us falling lower. Yeah. So we can identify buying signals from this point over here. So these are all instances. Sorry, you can identify selling opportunities. Yeah. Remember, we're in a downtrend, so you're only looking for sells. Yeah. And we can identify that over here, over here. The 3 times prices touched the upper band, we reversed. Yeah. And why is that important? Because if you look at the number of times price touched the lower band, it's not all the times that the prices reversed. Yeah. It's only, let's see, this is 1, this is 2, and we have another section over here. Remember, the smaller time frame is just a more detailed view of the higher time frame. So it's meant to make our work easier. Like that, and like that. So you can see the 3 times prices touch the upper band, we all managed to or it all managed to go lower. So we had very correct signals from the Bollinger Bands. However, the 2, 3, 4, 5, 6, 7, 8, the 9 times prices touched the lower band, we didn't have very accurate buy signals on all of them. So this is a way we have filtered good signals and bad signals from the Bollinger Bands based off a higher time frame, RSI. So the strategy is very straightforward. In this case, you are using Bollinger Bands and RSI to wait or to place trades. If price is an uptrend, wait for oversold conditions. That is, wait for prices to go to the lower band and then look for buying opportunities. If prices are in a downtrend, wait for overbought conditions. That is, wait for prices to go to the upper band and then look for selling opportunities. Very straightforward, and hopefully this strategy gives us an introduction to how to think like a trader and how to act like a trader and how to plan your time like a trader. So this is how a signal generation process will basically look like if you're starting out to trade. So this is the second installment of this market mastery series, and it's a very simple strategy that we can start with. In the next session, we will be looking at a more advanced strategy. We might spend a bit more of time on that, but this should be able to kick us off in our trading journey. See you in the next video.